Welcome to the Deep Dive. Today, we're really getting into the weeds of a major player in entertainment.
That's right. We've got Netflix's 2024 Form 10-K right here, their official annual report filed with the SEC.
And this isn't just a collection of numbers, is it? It's really their narrative for the year, how they see their business, their financial standing.
Exactly. It's like their official map. Shows you where they've been, but maybe more importantly, where they're trying to steer the ship.
Okay, so our mission here is to pull out the really key stuff, right? How the business actually works, the financial health, and, what they're actually doing to create value.
Precisely. We want to give you a clear, concise picture of their current position and where they might be heading next, based on what they're telling investors.
All right, let's dive in. The core business, obviously, entertainment services. The 10K says they hit, around 302 million paid members?
Yeah, end of 2024, across over 190 countries. And it's important to note it's not just streaming series and films anymore. They're making a real point about including games in that core offering now.
Interesting. And their strategy. The report outlines a core approach.
It does. It seems to be about balancing global expansion with keeping operating margins in check. That's the tightrope. And a huge part of that is constantly trying to improve the member experience.
Which means?
Well, it's several things. Compelling content is, number one, the stuff people talk about. Offering different price points, including that ad-supported plan. That's key now, too.
Right. Broadening the base.
Exactly. And actively trying to drive conversation around their shows and movies, plus continually tweaking the interface, making it easier for you to find something you actually want to watch.
The report mentions trends in membership growth, too. Q4 seems to be their big quarter, historically.
Yeah, that makes sense. Holidays, weather turning colder in many parts of the world. But they also make a really crucial point. Growth isn't just seasonal. It's directly tied to when they release big content and any changes they make to pricing or plans.
So a new season of a hit show drops or a major film lands, and you see a bump.
Absolutely. It pulls people in, and it likely helps keep existing members from leaving. And, when they adjust prices or introduce something like the ad tier, that directly impacts who signs up or sticks around. It's a constant calculation for them.
Let's talk content foundations. Intellectual property. They stress trademarks, copyrights, patents, but also rely heavily on licensing. How does that work?
Well, it's sort of a classic build versus buy scenario, right? Owning IP, think Stranger Things, gives them exclusive control, long-term value, potential for spin-offs, merchandise, the whole 9 yards.
Or control.
Definitely. But licensing lets them offer a much wider variety much faster, without the huge upfront production cost and risk for everything. The downside. Potential legal fights over rights and licensed stuff can disappear from the platform. It's not permanently theirs.
And then there's the whole regulatory environment. It sounds like things are getting more complex.
Yeah, the report flags increasing regulatory action, especially around cultural support legislation in some countries.
Like what, specifically?
You're seeing things like content quotas mandating a certain amount of local programming. Also levies, direct taxes on streaming services, or obligations to invest in local productions. Sometimes even rules about foreign ownership.
And content reviews.
That too, yeah. Some places are moving towards more formal review processes, which can obviously slow things down and add complexity. It's all about balancing global operations with local rules and cultural priorities.
Shifting gears a bit, they talk about human capital. Employees, culture. Seems important to them.
Very. They frame it as key to their success. Around 14,000 full-time employees at the end of 2024, mostly U.S. and Canada, but a global footprint. And they specifically mention their culture memo.
What does that signal, you think?
It signals that they know talent is crucial in this business, highlighting benefits health, mental health support, childcare, family planning, donation matching. It's all about attracting and keeping the best people. The culture memo mentioned suggests they believe their specific way of working is a competitive advantage.
Okay, no 10K is complete without the risk factors. And Netflix lists quite a few. What stands out?
Well, number one is always going to be attracting and retaining members. It sounds simple, but it's complex. Are people feeling they get enough value? Are they cutting costs? Do they like the content? Is competition pulling them away? Even customer service issues can play a part.
Plus seasonality in the economy.
Right. Q4 is strong, but other quarters might be softer. And inflation, recessions that squeezes household budgets and entertainment is often one of the first things people look at cutting.
What about the risks around their newer ventures? Games, live programming?
That's another big one. Expanding into new areas like games, live sports or events, even consumer products. It's about finding new growth avenues and deepening engagement. But there's always the risk that these things just don't take off with their audience or they struggle to execute them well. It's a gamble.
And competition. That seems like a constant pressure.
Intense is the word they use, and it feels right. You've got the huge legacy media companies with their own streaming services, plus newer, sometimes very well-funded players. They might have better deals with suppliers, maybe they price more aggressively, or just have more cash to throw at content and marketing.
And piracy doesn't go away.
Never. Still a significant drain. Plus, they mention new tech like generative AI. Who knows how that might shift the competitive landscape? It could help some competitors, or maybe even Netflix itself, create content differently or improve recommendations. It's an unknown.
Operational challenges too, right? Just managing the scale of it all.
Absolutely. Scaling globally, handling hundreds of millions of members, adding complex new features like advertising systems, live streaming infrastructure, producing original content worldwide, integrating any companies they might acquire. It's a massive operational lift.
Payment processing. Seems minor, but they list it.
It's critical infrastructure, dealing with countless payment methods globally, relying on third parties, potential for fraud, rising fees, service disruptions. Any hiccup there directly impacts revenue and member experience.
Cybersecurity must be high on the list too.
Has to be. They're a huge target. Disruptions, data breaches, member data, corporate secrets, even theft of upcoming content. It's a constant battle. And their reliance on cloud providers like AWS adds another layer. What happens if AWS has a major outage or a contract dispute?
Right. They can't just switch providers overnight.
Not easily, no. And even their own tech, the recommendation engine, the content delivery network, if that fails or underperforms, it directly hurts the service people pay for. Privacy, too. Handling all that personal data correctly is a massive compliance and reputational risk.
Okay, let's pivot to the numbers. How did 2024 shape up financially compared to 2023?
Pretty strong, actually. Total revenues jumped 16%, hitting just over $39 billion. That's up from about $33.7 billion the year before.
What drove that?
Mostly growth in the average number of paying members and price increases they implemented, although they did mention unfavorable foreign exchange rates took a bit of a bite out of that growth.
And streaming revenue specifically?
Same story, up 16% to match that $39 billion total. They noted a gain from hedging activities helped a bit in 2024, which wasn't there in 23. And as expected, DVD revenue went to zero. End of an era.
How did that flow through to the bottom line, operating income?
That saw an even bigger jump, up 50%, reached $10.4 billion compared to roughly $7 billion in 2023. So their operating margin improved significantly too, from 21% up to 27%. That suggests they got more efficient.
That's a healthy margin. What about the subscriber numbers themselves?
Really strong performance there in 2024. They added a net 41.35 million paid memberships globally. That's a 40% increase on the net adds from 2023.
Wow, quite an acceleration.
Yeah, it brought their total paid members to just over 301 million by year-end, up 16% overall. The average number of paying members throughout the year was also up 15%.
And the revenue per member?
That only went up slightly, about 1% to $11.70 average per month. But, and this is important, they sit on a constant currency basis, so ignoring FX impacts, it was actually up 4%.
Got it. Let's look in costs. Where's the money going?
The biggest chunk, unsurprisingly, is cost of revenues. That went up to over $21 billion, and the main driver within that is content amortization, basically, expensing the cost of their shows and movies over time.
How much was that?
Content amortization alone was $15.3 billion in 2024, up from $14.2 billion the year before. Shows you the scale of their ongoing content investment.
What about other operating expenses?
Sales and marketing costs increased, so did technology and development spend, though slightly. General and administrative costs were pretty flat year over year.
Okay. Any other notable financial movements? Interest, taxes.
Interest expense was up just a little, but they had a big swing in interest and other income, which turned into a positive $267 million, mainly because they had much lower foreign exchange losses compared to 2023. Taxes went up because profits were higher, but the effective tax rate stayed around 13%.
Which led to net income of?
A hefty $8.7 billion. That's a significant increase from the $5.4 billion in 2023.
And finally, cash in the balance sheet. How did they end the year?
Ended 2024 with a very strong cash position, almost $9.6 billion in cash equivalents and short-term investments. That's a big increase.
Where did that cash come from?
Mostly from operations, the core business generated good cash flow. They also issued some debt and stock. Offsetting that were cash outflows for share repurchases and paying back some debt. Their total debt did increase slightly overall.
And just to clarify, their big content spending is counted within operating cash flow, right?
Yes, payments for content acquisitions and productions are classified within operating activities. It underscores how central that spending is to their ongoing operations.
So how are they using this financial strength to reward shareholders?
Oh,
Dividends, buybacks.
the report doesn't mention any cash dividends, no change there, but they were very active with share buybacks again.
How active?
They spent $6.24 billion buying back their own stock in 2024. That's slightly more than they spent in 2023.
And what does that do?
It reduces the number of shares outstanding, which can boost earnings per share. It's a way to return capital to shareholders without a formal dividend. They ended the year holding almost 26 million shares in Treasury, costing them over $13 billion cumulatively.
Okay, putting it all together.
Yeah.
How does Netflix seem to view the road ahead based on this report?
Well, they state they might raise more debt capital down the line, depending on their plans and market conditions, but the core focus seems unchanged. Keep growing globally, keep making the service better with content and features.
And they know they have challenges.
Oh, absolutely. They acknowledge the need to navigate that increasingly complex regulatory world and the fierce competition. That's going to be key.
Any other major hurdles they seem focused on?
Managing those huge long-term content commitments is definitely one, especially if the economy turns sour. Continued heavy investment in tech, infrastructure, and especially cybersecurity is non-negotiable for them.
And making those new bets pay off.
Exactly. Success in areas like games, maybe live events, consumer products, that's likely where a lot of the future growth beyond core streaming might come from. They need those bets to work.
So let's wrap up this deep dive. 2024 looks like a banner year on paper, right? Strong growth in revenue, members, much better profitability.
Definitely. They invested heavily in content, returned a lot of cash via buybacks. But the report also paints a clear picture of just how complex and challenging this global streaming game really is. The risks are numerous.
Which brings us to a final thought for you, the listener.
Right. Think about this. Netflix has these massive, long-term, largely fixed commitments for content spending. In a media world that changes incredibly fast, with viewer tastes shifting, new technologies emerging, how does that big, fixed cost structure affect their ability to pivot quickly, to adapt to the next big disruption or shift in how people watch?
Something to chew on. How flexible can they really be? An excellent point.
It's a central tension in their model, for sure.
Well, that's all the time we have for this deep dive into Netflix's 10K. Thanks for joining us.
We'll catch you on the next one.